So good morning, everyone. Good morning. Good morning. I'm grateful you're here. My name is Diane Glover, and I am the Director of Business Development at Kirsch CPA Group. So I also have the pleasure of serving on the Fairfield Chamber of Commerce board with the team here. So I'm especially grateful to be here today. So first, I want to thank Peggy and the Chamber team for having us and giving us the opportunity to speak to you. The Chamber really does such great work in building our business community. What heck would be part of that? So at Kirsch, we partner with businesses to move beyond the numbers, really getting into helping a business level stronger, more profitable organization work through the process. So with that, one of the most impactful parts of that process is tax strategy, and that's what we're going to talk about today. So we'll present to you the key insights of the One Big Beautiful Bill, breaking down the bill, giving you some practical strategies that you can implement with your business. So I'm excited to introduce our speakers today. Sue Schlimmer is the director of the Kirsch CPA Group. She's been with us for 21. But in the business for over 25 years. She leads our tax practice. So it really specializes in pass-through entities. So looking at local taxes, or state and local taxes, R&D credits, whatever it takes to help boost that profitability and keep more of that income each year. And then Jared Weiler is the senior tax manager here at Kirsch. He's also one of our business advisors, so he spends time working with our clients to develop good growth strategies and then also good tax strategies to keep more of that money and really remain very profitable. So with that, thank you all for having us, and I'll turn it over to our experts.
Awesome. Cool. Perfect. Thanks, Diane. Thanks to the Fairfield Chamber for now. That's what
it's the foot pedal.
Okay, perfect. You got height differences here from the too.
Okay.
Everybody see the screen okay? So yeah, thanks for having us. Thanks for coming. People that are watching, thanks for tuning in. Obviously we knew that there was some sort of tax law change, whether whatever administration was going to come in, there's going to be a major change. Thankfully, we got that early, and we didn't get that in January when we're trying to file a tax return. So, but the good news is like Diane said, we have plenty of time to plan for year end, so that we can make sure that we are minimizing taxes over the lifetime of the business and the owner that we serve or the business owners that are here. So, beyond the beauty, again, this says business taxes, but as a lot of us in here know, that a lot of small businesses are structured as an S corporation or a partnership. So ultimately, that income is being taxed to the individual. So even though it says business taxes, and maybe our focus here is more from a business standpoint, it's really holistic, looking at it from a business and an individual standpoint. So here's just kind of a disclaimer. Again, we're still waiting on quite a bit of guidance from the IRS. So what we're presenting today is the rules as we know them. As more guidance comes out, there might be some changes as well, but that's going to be kind of ongoing over the next 6 to 8 months. So there's our faces if you wanted to see them. You probably don't. So we'll move on from that slide. But essentially, just a little bit about our firm. We're not going to spend a whole lot of time on this, but essentially the way our firm is structured and how our firm was founded was we want to be in a proactive, strategic advisory capacity with our clients. So what does that look like? This is kind of what we call our proven process. It's really going from the transactional that most accountants or most people view accountants into the strategic, right? So really from startup to succession, how do we get good numbers that then we can take and make proper business decisions. Then we can take to the next level, develop a business plan and a roadmap of where we want to take our clients or where our clients want to go in the action steps along the way. Part of the business is taxes. So that's what we're talking about today. And kind of the way we take taxes to a proactive, strategic standpoint is through tax planning. So pretty much most of all, not going to say every, but most of our tax clients we do tax planning for. And it's a really in-depth look of how can we minimize tax liabilities over the life of the business. So what does that mean? Taxes are a part of the business. They are the business. So how do we look at the business goals, the owner's goals, the future profitability projections, and how do we kind of look at the holistic picture and make sure that we're doing things from a tax perspective to ultimately keep more money in the client's pocket. The other part of that is planning for cash flow, right? I know probably some of you business owners, people that are business owners that have been hit with, hey, you owe 20 grand and it's April 10th and you got to move money around, pay that on April 15th. Okay, another goal of ours with tax planning is you're going to know what your tax liability is in that October, November, December timeframe, so you can plan from a cash flow perspective come April or whenever those payments are due. So that's kind of how we approach it. We obviously do the compliance stuff. We're really good at it, but we really, really focus on the fundamentals. So we're kind of going to break this out into two different sections. Again, they're very connected. So I'm going to talk about the business stuff, some of the business changes. And then Sue's going to talk about some of the individual changes. But like I said, very connected because most of our business owners are S corporations, partnerships, and all that income is going to flow through each other. So it's very holistic and it's connected to others. So on the business side of things, what are some of the massive changes? And we'll spend a little bit more time on some than others. But just from a depreciation standpoint, so bonus depreciation is back. So if you buy certain equipment, furniture, vehicles, you can write off that vehicle or piece of equipment or furniture in the first year. So you spend $50,000 on a certain vehicle that qualifies for bonus, you get a $50,000 deduction in the year that you purchase that vehicle. And that's for assets acquired after 1/19 of 2025. It's kind of one of those weird dates. But that is permanent going forward. So that will be the rule. Section 179 expensing. This is another similar to bonus depreciation. It's a way to get a full deduction from certain fixed assets in the year that you purchase it versus it being depreciated over some sort of useful life. So taking this kind of to the next level, how do you plan for this or what do we do with planning? Well, it's really, as business owners, looking at your fixed asset needs. So your equipment needs, your furniture needs, your vehicle needs, and really looking at that holistically. And does it maybe make sense to buy that before year end, right? And get that deduction this year versus maybe waiting until next year. You have time value of money, put more money back in your pocket that then you can use and reinvest in your business. From a real estate standpoint, if you have you're buying real property, whether that's commercial property or residential property that you're renting out or whatever. Another thing that you can do is you can do a cost segregation study on it. So if you buy a commercial property, typically that's depreciated over 39 years. Where now, if you do a cost seg study, you can break that out into some smaller asset classes and write off more of that up front, right? Again, putting more money back in your pocket sooner, time value of money. We all know $1 today is worth more than $1 tomorrow. So those are just some tricks that you have up your sleeve when you're doing tax planning. Okay, so this is a big change here. This is a completely new concept. So this is for clients that are in the manufacturing, agriculture, chemical production space. So where you're in a production type industry. So you're producing something. And we all know that this administration wanted to essentially bring manufacturing back to the United States and really encourage investment in manufacturing. This is one of the ways that they're doing this. So long story short, the old rules, if you bought a manufacturing facility, that's a non-residential piece of property. Generally, that would be depreciated over 39 years. So if you put $39,000 into a building, that's for a non-residential piece of property, you would get a $1,000 deduction this year and then over the next 39 years. This rule changed it. So now the piece of that property that's used for production, you can write off this year. So it's just the piece that's for production. So let's just use a quick example, right? So you build a property that's going to have a production facility in it that you're going to use to manufacture whatever you're manufacturing. It's got an office in it. It's got maybe a lunchroom in it, a little cubby or whatever that you put your food in, your drinks in. Just the portion of that property that's used for production, not the office space, not the lunchroom, not the cubby that's used to store drinks and food. Just the piece that's used for production can be written off this year. The rest is still depreciated over the normal useful life, which is typically 30 years. So again, it's encouraging. It's taking what would otherwise be a 39-year piece of property, and you're accelerating that deduction to this year. Again, that's really for encouraging these manufacturing companies to put money back into and invest into infrastructure to the United States. So there's some dates on this. This is not a permanent deal. It's only through it's really through 2030. So the property must be placed in service before 1/1 of 2031. The construction, if there's construction that has to be done, it had to start already essentially. There are some caveats with this. So the one is the property has to be used for 10 years in production. If it's not used for 10 years, so let's say we build a production facility and we only use it for production for 5 years, but you wrote off all those costs in the first year, you have to recapture those costs as income in the year that you essentially no longer use that property. So that's kind of the high level. I just want to show you an example of maybe what this looks like from a number standpoint. So this is kind of comparing the old rules to the new rules. So in this scenario, we're assuming client, manufacturer purchases or builds a $2 million piece of property. Under the old rules, that $2 million, assuming there's no land in that and there's no cost seg study done, that $2 million is depreciated over 39 years. So they would be getting a $51,000 deduction in the first year. That's all that is 139 for the $2 million. And then assuming that the taxpayers in the 37% tax bracket, they're getting a tax benefit from that deduction in the first year of $18,000 or $19,000. So that's under the old rules, assuming that that property is all 39 years old. Under the new rules, again, same scenario. They purchase a $2 million piece of property. We're going to assume that 50% of that property is used for production. So $1 million of that is related to the production portion of that property. Again, the production piece we can write off in the first year. So that first $1 million we can write off in the first year. The second $1 million is still depreciated over 39 years. So that's where we're getting the first year depreciation deduction is $1,025,000. And then again, assuming there's a 37% tax rate for this taxpayer in a 37% tax bracket, that's a tax savings or a tax benefit of about $380,000. So if you just look at the difference between those, that's putting $360,000 back into the client's pocket by taking advantage of this code section. So again, a lot of assumptions built into there. It's vary depending on what tax bracket the client's in or the taxpayer's in, but massive benefit from this if it's done.
Will the IRS have the ability to do a look back?
For what? I thought
if they didn't keep it for 10 years, they abandoned after 5.
Yeah.
Do they have a capability to look back and catch them?
Yeah, I mean, they could audit them. Generally, the statute of limitations is 3 years to go back and audit. If it's pure fraudulent, they can look at it whatever. But yeah,
I guess my front part believes somewhere where the rest of long money abandoned it in 5 years.
Yeah.
Yeah, I was just thinking that's a chance the IRS would even catch them if they did.
Right. Yeah. I mean, that's the risk, right? But yeah, I mean, this is generally when you have big code sections like this and you're taking massive deductions, the IRS is looking at those things. So those are on their radar, those are in their system. So I wouldn't recommend it, but it's a good question.
Thank you. It just kind of flying through my mind, and then I started thinking there's not going to be any money there anyway. It was abandoned, probably going out of business, so the fund's gone anyway.
Exactly. So I know we have a banking crew here, so this is a massive opportunity to have clients in the manufacturing space that need more production capability to really talk to them, be proactive with them, and encourage investment and the problem. Any other questions on that? We'll have kind of time for Q&A. All right, so this is one we've been waiting on for the past probably, 5 years.
Yes.
Research and R&D expense deduction. So just to give kind of a little bit of background, and to not be too CPA-ish here, essentially what happened before 2022, if you had R&D expenses, you could deduct them in the year incurred. So in 21, if you had $100,000 of R&D expenses, you got a $100,000 deduction. As part of the previous bill, there was a budget kind of, right, this was kind of to reconcile the budget. In 2022, starting in 2022, and in this case, it went to 2024, R&D expenses had to be capitalized and amortized over 5 years. So again, using that same example, you have $100,000 of R&D expenses in 2022. You can only deduct 20,000. Again, using simple math, you can only deduct 20,000 in 22, and then you get a $20,000 deduction over the next 4 years. So that's what the rules were. This was a massive problem for a lot of businesses. You think like a business in the tech startup space, where most of their expenses are R&D related. You would see a lot of clients that would go from a lost position now having income and having to fork out cash to pay tax on that because they weren't getting the deduction now, they're getting it later. We also saw that a lot in the manufacturing space, many different spaces that are heavy R&D spaces, where income maybe was down here usually, but because there's this massive add back, now it's all the way up here because they aren't getting that deduction in that first year. So we've been waiting on this change for a long time. But essentially, now it's going back to kind of the old rules for domestic R&D. So you get the deduction in the year that it's incurred. So you have $100,000. You put $100,000 towards R&D in 2025. You get a $100,000 deduction in 2025. Then you can also take the credit. For foreign R&D expenses, the rules are staying the same as the old rules. You have to capitalize them, except you have to amortize them over 15 years. So again, this is incentivizing doing R&D domestically, because you get the deduction immediately if you do it domestically. You have to capitalize and amortize. You get the deduction over 15 years if you do it full. So where does the planning come into place? So this kind of next section is where there's a heavy planning opportunity. Because like I said, through 2022, through 2024, we had to add all these back, and then you could only take the deduction over 5 years, right? So now we have all these amounts sitting there that haven't been deducted yet from 22 to 2024. So what do we do with those is really the question, and they're giving us options. So if you're a business that has less than 31 million in gross receipts, you really have 4 different options. You can go back and you can amend 22 to 24. So you can essentially go back and deduct those expenses in full in 22 to 24. You can take a catch-up deduction, so you can deduct whatever's left. So let's say you have $1 million of capitalized expenses that you haven't deducted yet from those years. You can take all that deduction in 25. Or you can take half of that deduction in 25, half of it in 26. Or you can just leave it as is and amortize it as usual. So there's a lot of options here, which call for major planning opportunities. For businesses that are greater than 31 million in gross receipts, pretty much have the same options as the 31 million in gross receipts, or less than 31 million in gross receipts companies, except we can amend 22 to 20. So what we're kind of getting at is there's a lot of different factors playing, and we're still waiting for guidance on some of this stuff, but it's really trying to take those deductions in the year that you're going to receive the biggest tax benefit for it. So what does that mean? Well, if you go back and you amend 22 to 24, there's going to be interest on those refunds. And we all know that interest rates were like 7-8% during those times. So there could be a pretty massive interest income coming into your pocket on top of the refunds from the deductions. So that's fact. Tax brackets, tax rates, depending on where the client was from an income perspective. That's a huge factor. If they maybe had a loss in 22 or 23 or 24, it probably doesn't make sense to go back and amend those because you're just going to drive them into a bigger loss and there's not going to be a refund. So you want to take those deductions in the year where income was the highest, so you're getting the benefit at the highest rates. The other consideration from amending, right, is the IRS is pretty slow right now, especially with amendments. So you have no idea when you're going to get those refunds or when they're going to process those returns. So the timetable for that is really kind of uncertain at this point. So there's a lot of different options here, and weighing those options and seeing what's best for the business from a planning perspective of when we should take these expenses from 22 to 24, it is really, really key. Because I mean, we have numerous clients where they have millions of dollars in R&D expenses. So they have, just thinking of one client off, I mean, they have $3 million of a deduction that we have to figure out what to do with. And we have to weigh really 22 to 24, or should we take it all on 25, or should we split it between 25 and 26? Does that kind of make sense? Any questions on that? It's kind of complex topic, but it's a much needed one to, incentivize R&D in the United States. So big benefit for clients that are doing R&D. Okay, qualified small business stock. So just to give a little bit of background on this. So one of the biggest things, especially when we have a client that just bought a business or they're starting a business, or just ongoing and facts and circumstances change, one of the main things we look at is entity structure. So you have a lot of different entity types you can choose from, and each one of those entity types, they have different tax consequences to them. One of those entity types that we can choose from is a C corporation. So qualified small business stock is part of the C corporation rules, and it applies to businesses that qualify as a qualified small business. So in that case, it's really the old rules were a business that had assets less than $50 million and were in certain industries was really what was a qualified small business. Now that increased to 75 million. But essentially what this code section is, and the benefit of it is if you qualify under section 1202, and the client that holds the stock or the taxpayer that holds the stock sells that stock, they can either get a full or a partial exclusion from the gain. So think of it like you hold stock in Apple, you bought it for 100, you sell it for 200. The 200 less the $100 base, if you have a $100 gain, you're paying tax on that $100. Okay. If you take the same situation, let's just use bigger numbers because usually it is bigger numbers when you're holding the stock of a qualified small business. Let's say you have a client that sells their stock in qualified small business for 10 million, and they only put 1,000 in to start. Well, they have a massive gain there that they normally would pay tax on when they sell it. Well, if it qualifies under these rules, that gain is essentially excluded from income. So they aren't paying tax on that. And again, capital gains rates are usually 20% generally if you're a high income taxpayer. So you're potentially saving 20% on that $10 million. So that's $2 million back to the taxpayer's pocket. So that's really the benefit of this. So what's the max gain exclusion per shareholder? It's the greater of 15 million or 10 times their basis. That used to be 10 million, so that went up. The asset limit, like I said, increased to 75 million, so that's total assets within the C corporation. Qualify as a qualified small business. The holding period, this also changed. It used to be to have any benefit of the qualified small business stock rules, you had to hold the stock for 5 or more years. Now there's a little bit of a phase in. So if you hold it for 3 years, you can exclude up to 50% of the gain. If you hold it for 4 years, you can exclude up to 75% of the gain. Then it's still got the 5 years where you can exclude up to 100% of the gain. And then this only applies to stock issued after really the date that this bill was signed, which was July 4th of 2025. So just to talk about some of the practical things here, and what you'll see as we kind of go through this, a lot of these things are intertwined. So when we're talking about entity structure, right? One of the things we got to look at is, okay, what are the client's goals, right? If the client's not looking to sell in 5 years, or they're looking to hold for a long period, this probably doesn't really make a whole lot of sense. And the reason why is the C corporation tax rate's at 21%. The C corporation dividend rate is generally 15 or 20%. So when a owner takes out money from the C corporation, that's a taxable dividend. So if you add 21% and 15 or 20%, you're looking at a combined rate of 36 to 41% that they're essentially paying tax on their income if they're a C corporation. Or if you structure them as an S corporation, the highest individual rate is 37%. That's the highest one. So it's anywhere from 10 to 37%. So That's already lower than probably the combined C corp rate. And then on top of that, we have the QBI deduction, so the qualified business income deduction, which is at 20% of the business income. So if they have $1 million of business income, if they do structure things right, there's no limitations. They're only paying tax on $800,000 of that. So really, the combined the highest rate of an S corporation is 29.6%. So you're looking at a big difference there between rates. That's a big play. So really, that's one of the biggest keys is, are they really looking to sell? There's a big rate difference. Maybe we can spin off a piece of their development that maybe they're going to sell. There's a lot of different planning opportunities, but this is certainly a really beneficial provision for certain businesses, not for everybody. I'm going to fly kind of through these ones. Essentially, the business interest expense limitation for larger taxpayers that have a lot of interest expense, this kind of gets held up. So they can't deduct it if their income's not high enough. What this change did is it essentially increased. You can now add back depreciation and amortization to that base that limits it. So you add back depreciation and amortization to your income, and essentially what that results in is more of your interest expense can be deducted. So if you have specific questions on that, happy to talk. But that's the big change there. Is essentially more interest expense will be able to be deducted for larger businesses. Excess business loss limitation. Essentially, what this is, and this is just a carryover from previous law. What the IRS doesn't want you to do with this is they don't want you to take losses from your business to offset your other income. So they want to limit the amount of losses that you can take from your business to offset things like interest, dividends, capital gains at the personal level. So that just got extended from previous law. Again, not a huge. There's some planning opportunities there, but not a huge change from what we previously had. This is another major extension. I briefly talked about it earlier. The QBI deduction. This was previously set to expire at the end of 25. Now it's been permanently extended. What this allows certain business owners to do that qualify as qualified business, or their income qualifies as qualified business income. It allows them a 20% deduction at the personal level for their business income. So, like I said earlier, if they have $1 million of income, they maximize the QBI deduction. They're only paying tax on any $8,000. There's also some different rules in here, smaller rules for service businesses, and then it also created a minimum $400 QBI deduction for all businesses that have over $1,000 at the beginning. So not a huge change here, but a really big extension, more or less. It's something that definitely needs to be playing around, make sure that's being taken advantage of. A couple other provisions that kind of changed, or we're still expecting even more changes from. Not going to spend a ton of time on these, but so the opportunity zone rules, those got extended. There's also been a few different changes there related to reporting and when you can invest in those opportunity zones. New market tax credits got extended. Those were previously set to expire. Those are really to incentivize investment in low income housing. So those are still available. And then the green energy changes, I think that's probably the biggest thing on this slide. So those are set to phase out over the next, really, depending on which one we're talking about, between 25 and 2027. A lot of these energy efficient credits are going to phase out. So kind of the key there is if you're going to invest in green energy and want to take these energy efficient credits, do it sooner than later. And by sooner, most likely in 2025 versus in 2026 or 2027, because these credits are going to go away. So that's really the key takeaway there. And there's probably 15 different credits, and there's different date ranges that are going to expire or go away. So that's kind of what I have on the business front. And with that, I'll pass it over to Sue for the individual provisions.
Right. So as Jared mentioned, when we're talking about the individual tax provisions here, think about when we talk about most of the businesses are structured as pass-through entities, whether you're a sole proprietorship, an S corporation, or partnership. That taxable income gets passed on to the owners who are responsible for paying the tax on those business profits. So what happens on your individual tax return might dictate what tax bracket you're in and how much business taxes you're paying. And the level of business taxes you have may impact the ability you have to take some of these tax benefits that we're going to talk about here. So they're certainly intertwined. So the first one here is the state and local tax deduction. You may have heard it referred to previously as the SALT cap. So going back to pre-2017, so several years ago, when the Tax Cuts and Jobs Act was put in place, prior to that, if you itemized your deductions, you could deduct an unlimited amount of state and local taxes, which would include income taxes, real estate taxes, and personal property taxes. The Tax Cuts and Jobs Act put a $10,000 cap on that. So if you itemize deductions, you can only deduct $10,000 of those taxes. So think about it, if you have a business where that income is passing through your tax return, it doesn't necessarily take a whole lot to get over that $10,000 limit when you are responsible for paying the state income tax, the local income tax that is that is on those business profits. So this has been a very controversial point for a number of years. You can see a lot of people didn't like it. Owners of businesses were highly impacted. Taxpayers in high tax states didn't like it. So it was a controversial point, and it was a big negotiating sticking point as they were working through one big, beautiful bill act. So what they did was they increased the cap to $40,000 for 2025. And it has some annual increases here for inflation. But this cap is only going to be in effect for a few years, in 2026 through 2029. And at that point, reverts back to a $10,000 cap unless Congress acts again. So of course they could act to extend it, they can make it permanent, and do a variety of things. But where we stand right now, this is available for 2026 through 2029. But there are a few little rules that kind of come into play with this as well. And one of them is a deduction phase out range between $500,000 and $600,000. What that means is if your adjusted gross income is at $500,000 or below, and you itemize your deductions, you can deduct the $40,000 of state and local taxes on your tax return. If you're over $600,000, you fall back to this $10,000 cap. So the higher income earners or higher income taxpayers don't get benefit of this increased phase out or increased SALT cap. If you're in that range of the $500,000 to $600,000, there is a sliding scale where it gets reduced down over that period of income difference there. So one thing to keep in mind is an opportunity is the pass-through entity tax election still remains in effect for S corporations and partnerships. So there's a lot of talk maybe this is going away. Fortunately, it did not. So if you own a pass-through business, there's an ability for you to make an election to say, well, my business is going to pay the state level tax on this income. And these pass-through entity tax elections are available in most of the states, including all of them in our tri-state here, Ohio, Kentucky, and Indiana. And when the entity pays the state level tax, what that does is it reduces the profits of the business. They get to take a deduction for that tax. So a lesser amount of income is being passed out to the individual owners' tax returns that they would have to pay tax on. And it's essentially a way for them to circumvent the SALT cap. They get benefit of the full deduction of the taxes by having a lower amount of business income passed through to them. So that's a pretty big benefit for owners of the pass-through entities. But what I do want to also hit on here is this phase-out range and what the impact of that can be. So I want to show an example here of, if you look at this base year, if we take someone whose adjusted gross income is at $500,000, and if they have total itemized deductions of $75,000, and if that's made up of the $40,000 SALT cap and $35,000 of other itemized deductions, which could include things like home mortgage interest, charitable contributions, possibly some medical deductions and things like that. that person would have a taxable income $425,000 and federal income tax of roughly $118,000. So let's say there was an additional $100,000 of income that that person recognizes in the year. So if the AGI number starts at $600,000, our itemized deductions are now down to $45,000 because our SALT cap is completely, the increased SALT cap is completely phased out and we're limited to the $10,000. That's a $550,000 of taxable income and federal tax of about $164,000. So you can see this difference here is an increase of federal tax about $45,500. That doesn't include your state and local taxes on this. So a $100,000 increase in your income could be taxed at, once you throw in state and local taxes as well, at almost a 50% tax when you take into affect the loss of this SALT cap. So if you are falling kind of in between this range, if there's any strategies that you can implement to stay at the $500,000 or lower, you can avoid having some of that income. You're just thinking you have an extra $100,000 of income, but only $50,000 of that is in your pocket. Utilizing strategies to not be in that range is a good thing. So some of the things you can think about is, are you maximizing your retirement contributions, your HSA contributions, anything like that can drive down your income. If you have a pass-through business, depending on which type of or method of accounting you're using, are there ways that you can defer income in the current year? Could you accelerate deductions in the current year? And sometimes this might be a play that you look at over a couple of years. If you're going to be between that $500,000 and $600,000, in year one and year two, is there a way you can bunch things together in one year or the other so you get the benefit in one year, even though you're going to have to maybe fall in this range or above it in the other year? So looking at things over a period of time can often be beneficial to make sure you're maximizing the use of these benefits here if we additional SALT cap.
Excuse me, before you continue, you gave some examples of things you can use as forward accumulated platform. You said retirement contribution, hardship, and all other things.
So retirement contributions, if you have a health savings account, maximizing health savings contributions. If you have it's easier sometimes with a cash basis business, but sometimes if you're in a tool basis business as well, you could have an opportunity where you defer some of your income. And there's going to be some, specific circumstances where we'd have to look to see what we can do in those areas. But let's say as a cash basis business, if you do not collect revenue from your customers during the year, so you don't have that cash in your pocket yet, you don't have to pay tax on it. So let's say if you're a service business and you went out and provided a service to me and you gave me an invoice and I didn't pay you until after the end of the calendar year, you don't have to recognize that income. So some people might strategically look at, when do I send my invoicing out? My collection cycle is typically 30 days. Maybe I'm going to send that invoice out later in December to encourage someone to defer payment, and I can push that into the following year.
Sure.
Same thing for a cash basis business when it comes to deducting their expenses. If you have some accounts payable at the end of the year, you might want to make sure that those things get paid and you can make the deduction in that year. Versus if you would defer and pay them after the first of the year, it would be a deduction the following year. So just a few strategies to think about there. It's going to be business to business dependent. But those of you kind of the spirit of things there. Thank you. Do you have any other real quick? All right, this next one here, so no tax on tips and overtime. So that might affect individuals here in this room, or it might affect some of the employees that people have. And there's a lot of questions that have come out about this, and I think there's a lot of probably unknowns and misconceptions that are out there as well. So when we talk about the no tax on tips, there is a deduction limit of up to $25,000 per taxpayer per year. So if you have a joint tax return filer, and if both taxpayer and spouse work in an industry where they receive tips, you could potentially receive a $50,000 tax deduction related to those tips on your tax return. And this year is an above the line deduction, meaning that you would qualify for this deduction regardless of whether or not you itemize your deductions. So if you take the standard deduction, you can still qualify for this no tax on tips deduction. It does only apply for a limited amount of time. So years 2025 through 2028, the years it's effective for. Now, of course, everything that Congress does is going to come with some other limitations as well. And one of them is a phase out range. So if your joint income is over $300,000 for other filers, so whether you're a single filer, head of household, or other filing methods, if your income is over $150,000, you're going to start to receive a phase out of this benefit. So higher income earners are not going to be able to receive this tips deduction. Another point is that the tips deduction is only available for some specified industries. And the IRS will be publishing a list. We're committed to get a list out in October of this year of which industries will qualify for that tip. So think of occupations, wait staff, hairstylists, driving services. Those are ones that will obviously fall in that area. But of course, the IRS is onto schemes that people can have, converting compensation into tips as well. So they're excluding things that are not typically in industries that you would otherwise receive tips. So we'll be awaiting guidance coming out on that list from the IRS. But your typical ones that you think about will certainly be qualifying in that area. Another point on this tips deduction is it only applies to voluntary tips. So if you think you go out a large crowd to a restaurant, there could be a service charge or an automatic gratuity added onto a check. That does not count toward this tips deduction. It has to be a voluntary tip that's given. So whether or not some people in those types of industries, the restaurant industries, might get some pushback from their employees a little bit, not liking the idea of an automatic gratuity, which may have been, a thing that they liked in the past. They can guarantee that they were going to get a certain level of compensation or tip there. But if it's excluded, if it's not an automatic gratuity and it's a voluntary tip, it would qualify for this deduction. So just a couple little sticking points out there on that. Another point is that the tips exclusion is an exclusion from income tax. It is not an exclusion from payroll taxes. So your Social Security and Medicare taxes will still apply to the tips that you receive. And those tips are always reported on taxpayers' W-2s. The next point here is the no tax on overtime. There's also a lot of parameters around this one as well. So this one is a deduction limit of $25,000 for a joint file tax return, $12,500 for others. Applies the same time period here, 2025 through 2028. Above the line deduction. So not required to itemize. If you take a standard deduction, you can still qualify for this. And it has the similar phase outs. But this no tax on overtime isn't available to everyone. It is only available for overtime paid to FSLA non-exempt employees. So if you think of your typical blue collar workers and things in manufacturing, it does not apply to overtime wages that are paid to an exempt employee. So if you have someone in a professional service or manager, they're typically considered exempt from the overtime rules. Even if an employer pays them overtime, they're not required to pay overtime under the FSLA. So it's only to the FSLA non-exempt employees. A couple of other things here is that I lost my train of thought of where I was going with another point here on the overtime. I thought it was something important. So give me just a second here to I can see where I'm missing. Oh, there was going to be, that's another big point here. I was thinking is that there is not going to be a change to the W-2 forms for the 2025 tax year. So what we do need to wait on is guidance from the IRS about how do we notify our employees of how much their compensation is overtime. There will be changes to the W-2s for 2026 and forward. So we'll have to wait and figure out, the best way that that's going to be reported there for 2025 or notified. Might not necessarily go to the IRS, but notifications to the employees.
Sorry,
Yep, what?
will that be retroactive then for all of 25?
It is retroactive for all of 25, yes. And the no tax on overtime here only applies to the extra overtime premium part. So if you think of overtime pay as being time and a half, this deduction only applies to the half-time component. So that I think is where it's a big unknown for a lot of people. And they think my overtime pay is going to be excluded. It's just the premium on the overtime that's excluded.
There's a top part of that.
Yes. So if someone makes $20 an hour, they work 1 hour of overtime, so they receive $30 of pay for that 1 hour. They're entitled to this deduction for $10, and that base part of their wage, the $20, is not eligible for deduction. So it's probably not going to be as big of a benefit as someone may think it is, but certainly people that do work a significant amount of overtime can benefit here from this no tax on overtime. Yes.
The state ministries typically do holiday pay of time and a half. It's the same for holiday pay too, or
It does not apply to holiday pay or any kind of shift differential or other pay like that. It is purely to overtime pay only.
So would you say the payroll companies are going to apply that in a system to affect what we are going to do, what are we going to be doing? I think what's biggest mention, let's say ADP, they should be able to figure out what is supposed to, what figure they're overtime people from that time. So
Yes,
in my understanding.
yes, yes. So the payroll companies should be able to generate that income based on the inputs and the information we've provided. The reason they're not going back and adjusting the W-2s for 2025 is they're giving payroll companies and everyone else time to kind of get their ducks in a row, get their software and everything set up and be prepared for this. So they do understand that 2025 numbers might be estimated a little bit because it is a retroactive provision. But going forward, there's an expectation that everyone will be programmed and ready for 2026 and on for reporting. But certainly when you do report your wage compensation information to the payroll companies, a lot of them on a pay stub itself, there's going to be a differentiation line of your wages in your overtime in separate lines so that they do capture that information.
Then, like the tax on tips, I'm assuming that Social Security, Medicare, those taxes are still applying.
Yes. Yes. So it's not an exclusion from any of the payroll taxes. It's just an income tax deduction for the recipient of that pay. All right, the next one here, a limitation on itemized deductions. So a lot of things that we've talked about have been some wins for taxpayers at various levels of income. But of course, there had to be some revenue raisers that came into play. And they're going to pick on people that are in the highest tax bracket here. So for a taxpayer that's in the 37% tax bracket, there is going to be a new ceiling placed on the amount of itemized deductions that they can take. Kind of a weird looking formula when you look at it here, when you see 2/37 of the lesser of, some numbers here, the lesser of itemized deductions are to excess over the 37% bracket. Sounds like a lot of confusing mumbo jumbo. But essentially what it means is if you're in the top tax bracket of 37%, they're going to limit the benefit of your itemized deductions to 35%. So your income might be taxed at 37%, but you're only going to get tax deductions at 35%. So you're going to take a 2% haircut off of your itemized deductions. And that'll come into play beginning in 2026. So for anyone out here that's not very familiar with tax brackets, and you might be wondering, well, who's falling in this tax bracket here at 37%? It's roughly $630,000 for an individual tax filer, and a little over $750,000 for a joint tax filer. So you might think wealthy individuals, but when you also think of business owners that have that pass-through income not flowing through under their tax return, they could get up into that bracket pretty quickly. All right, next one here, you may have all heard of a senior deduction. So someone that's a senior is considered somebody that's age of 65 and over. And they're entitled to a $6,000 per senior deduction for the years of 2025 through 2028. So filing a joint tax return, that's a $12,000 senior deduction that a married couple can take if both taxpayers are over $12,000. And there's a phase out on this as well if income's over $150,000 or $75,000 for seniors. I just want to put that one out there as an informational one. You may have heard out there. Charitable contributions. Here's another one that they're going to a little bit of maybe a revenue raiser, or it's going to spread the wealth over the ability to take some charitable contribution deductions. And that is if you itemize deductions, beginning in 2026, there is going to be a limit where you cannot deduct the first 0.5% of your AGI contributions, I guess, that make up the first 0.5% of your adjusted gross income. So if you think of someone that makes $200,000 in income, they itemize their deductions and claim charitable contributions. They're not going to be able to deduct the first $1,000 of charitable contributions that they make. It's going to be a little haircut there that it's the 0.5% of AGI exclusion for your charitable contributions. This was kind of put into place to make up for this next provision here for the non-itemizers. So if you do not itemize your deductions, there's going to be an above the line deduction that you could take for $1,000 for single taxpayers, or for $2,000 for married taxpayers, for contributions that you've not gotten a tax benefit from taking for. It's a little bit of a controversial point, I think, on some of the charities out there, because their probably highest donors are being limited by their contributions to enable some of the lower earners or people that are in the lower brackets that are not necessarily itemizing their deductions to also get benefit of some charitable deductions there. So if you think about the higher earners, we talked about there's a little bit of a haircut where you're not getting full benefit of your itemized deductions. The other piece here is you may also be limited on your charitable deductions as well. I'm going to go through these really quick here. Some new things that are on the horizon. One of them is contributions that are made to scholarship granting organizations. Now, this point doesn't come into play until it's not effective until after 2026, so your 2027 tax year and forward. There is a new federal tax credit of up to $1,700 per year for individuals who make contributions to these SGO organizations. Currently, many of the states, including Ohio and Kentucky, I'm not sure about Indiana, but I know certainly Ohio, where we sit today, allows such a credit on their tax return. So while the federal credit's not coming into play until 2027, there is a credit in place right now for the state of Ohio. It's a little bit lesser. It's $750 for an individual, $1,500 for a joint couple. And it's to make private education more widely available and available to lower income people that qualify for these credits. So a lot of people in our area support some private parochial schools. And you'll be eligible for right now a state tax credit, but beginning in 2027, a federal tax credit.
In addition to the state?
No. So that is a couple of caveats there. If you receive the state credit, you have to reduce your federal credit. They're not going to let you double dip and take it twice. And you also cannot claim an itemized deduction as a charitable contribution for those same dollars that you're paying to the scholarship organization. So keep that in mind out there, just on the horizon that state impact is out there right now.
So does that include more than just schools, like community foundation?
Yeah, it's to scholarship granting organizations. Now, there are a couple of requirements out there where they have to, where the organization itself has to qualify.
Sure.
And it's based on how they give
So Kiwanis.
Yeah, so
Might give a scholarship to kids in a high school.
if it's qualifying to people in the right income range and the right dollar amounts of scholarship, or like the majority of the money has to actually go to the scholarship itself. And there's some limitations out there as far as the income level of the recipients. So I know if you go to the state of Ohio's website, there's a link to qualifying scholarship granting organizations out there, or if you have specific questions that happy to talk to you about. 529 accounts, just some really quick things. K through 12 expenses became eligible a few years ago. They increased that from $10,000 to $20,000 effective after 2025. There's some expanded expenses that are eligible to be used 529 funds for, and 529 plans can also be used to cover some post-secondary credentialing. So if you have a professional license and apprenticeship program, things like that can now be used for $529 million. Qualified passenger vehicle interest. This is new for this year, or beginning in 2025. It's only available 25 through 2028. That's a deduction of up to $10,000 of interest per year. And it only applies to new vehicles, so not leased vehicles or used vehicles. New vehicles purchased pretty much in the same day ranges, so after 2024 and before 2029. So if you have a vehicle that you purchased last year and you're paying interest on it, sorry, that's not going to qualify. It has to be purchased during the years that the deduction is in effect. And it's for vehicles with a gross vehicle weight of less than 14,000 pounds. And another sticking point you have to make sure is that final assembly has to happen in the U.S. So if it's completely assembled as a foreign vehicle imported into the U.S., it's not eligible for this deduction. And also there's a phase out range on this as well, which is the $200,000 AGI point there. Just really quick, there is a change here related to gambling losses. Maybe or hopefully this doesn't apply to most of us here. But previously, gambling losses you can only deduct to the extent that you get gambling winnings. So if you have a substantial amount of gambling losses, maybe it's not a big change for you. But let's say you had a modest amount of gambling losses and you had some gambling winnings. There's going to be a limitation of that deduction beginning next year. So let's think of if you had $10,000 of gambling winnings, $5,000 of losses. Under the old rules, you would have a net $5,000 tax impact. Now, you can only deduct $90,000 of your gambling winnings. You can only deduct $4,500 for that. So, $5,500 net gambling winnings should be taxed on here. Another big win I have on here is extended items. It might not seem like it's big of a deal because things are status quo. They're as you're used to. The individual tax rates that came into play with the Tax Cuts and Jobs Act have been made permanent. So the tax rate stays at 37%, as well as the enhanced standard deductions stay in place. These were both set to scale back pretty significantly if the Congress didn't take action. So the old rates expired at the end of 25. So this is a big win here to say status quo with what you know now, and you won't be seeing a tax increase.
Can I ask a question here? How come when people file taxes as single, they feel I think singles and head of household, singles pay with, I think one of them takes more than the other, they will be a single. Like,
So most of the brackets are designed that if you file married, you get double the amount of brackets and you fall in the rates of double the amount of what a single taxpayer would file. Just saying, two people together, they each get benefit of a lower bracket.
the difference between the single and then the head of household. Somebody can.
It's kind of a blended. It's more than what a single gets and less than what a joint filer gets often. But for a lot of these deductions that we've talked about are limitations. The single and head of household are going to have the same phase outs like them.
So,
Yes. Now we're running short on time. I want to go through a couple of other things really quick here. I won't spend a lot of time on this one. The federal, state, and gift tax exemption is increased to $15 million for 2026. This was scheduled to fall back to roughly $7 million. So this extension of The increases that we've been seeing is a big win. It takes away a lot of the uncertainty. So people that are doing estate planning kind of know what the future holds instead of thinking that this is going to drop back. Estate planning is still very important. It's something you need to think about, even if you're not quite in that $15 million. Small business owners, again, as your business grows, hopefully if you're growing your business, selling your business down the road, you're going to sell it for substantial amounts, so your estate could grow to more than this. So something to be aware of going forward, and that will be indexed for inflation. Another thing you may have heard is Trump accounts out there. There's some information on the slide. I won't read through everything on this. These accounts will not be available until after July 4th of 2026 at the earliest. They are not as favorable as maybe some of the House or Senate versions were. What got passed in the final version was very limited, but it's the ability to fund some accounts for children when they're at younger ages, and then they can get converted and treated like traditional IRAs after they reach the age of 18. I'm sure there's going to be a lot more that's published out there and a lot of guidance that comes out from the IRS on this as we get closer to 7/4/2026 date. I think two more things here that I think Jared's going to hit really quick on before we wrap up.
Yeah, these will be quick. So 1099 reporting, this is just kind of more of a relief of the administrative burden on small businesses. So it used to be the threshold for 1099 tests and 1099 NEC used to be $600. It's going to be raised to $2,000. Again, this is effective for 26, so 2025 it's still the 600. And then these will be indexed for inflation, and then also the 1099K reporting have also increased $20,000 in 200 transactions. So it's more of a administrative relief there for small businesses. This one I'm going to hit on very, very quickly. The employee retention credit. That one's obviously been going around since the beginning of COVID. And there was this kind of date thrown out at the end of January 31 of 2024. It was never passed. But essentially what this does is if you file a claim for Q3 of 2021 or Q4 of 2021 after the January 31st, 2024 date, you're not going to get that money. Now, Q3 of 21 is really the only big quarter there because Q4 was only applicable to startup businesses. So, but it's just at least limited to one quarter. So if you or somebody you know got filed a claim for Q3 of 21 after this date, don't expect to receive that money. It also extended the statute of limitations to 6 years for those quarters, so the IRS can go back and look at it longer versus the 3-year statute of limitations. So that's what we have. I think just a couple additional points. We use the term permanent a lot in this presentation for some of these provisions, and permanent really means just until somebody changes it. So I know Sue talked about the $15 million state exemption. Well, that's in place until somebody changed. So if we have a new administration at some point, that might go back down. So planning ahead for that is really key. The other point I would say, and Sue and I have talked about, and I think the more I read into this stuff, the more I believe this. Over the years, we've kind of heard, well, I've got a small business, or my taxes are pretty simple, so I don't need to do any planning. You saw a lot of these phase out ranges and whatnot, and I think with all the intertwined pieces of this bill, planning has become more and more key for pretty much anybody that makes income or that has income, because all these things are intertwined. They all work together in making sure we reduce that tax liability from year to year, which is really, really important. So at least having a conversation or looking at it yourself, it is really, really key for this year goal. So that would be kind of my key points. Anything to add?
Yeah, I think it's great.
Awesome. Well, any questions?
So our information is available for follow-up. If you have questions, feel free to check in with Sue or Jared or myself. We'd be happy to help. For the LCNB folks, if you have manufacturers that you're talking to and like a little consult, Jared and Sue would be available and say, here's how tax involved. We appreciate that.
Yep. Perfect. Yeah, feel free to reach out to us if we can help in any way. And thanks for coming and listening. So
Thank you.
thanks for
Thank you so much. Anybody has any questions for the chamber, you can grab me. We'll get this online. I need a copy of those slides though, because the camera wasn't quite picking up the TV all the time. So I want to make sure those get embedded on there. And thank you guys for coming and come back for some of our other upcoming. Well, what do we else? We also have cybersecurity coming up in October.
Cybersecurity is in October. Social media strategies is in September. The auditor is coming.
Yeah, Keith Faber wanted to come to here do a roundtable. That's in the end of October. I think it's Halloween. I think it's October 31st or the 30th, maybe. And then we have the 29th, the day before. We actually have a presentation, our regular quarterly roundtable with their office doing cohesive teams. So I think that'd be a really good one too.
So if there's any that you want,
Yeah, if you have a topic you're
if you have a
interested in.
topic you're interested in, let us know and then we can find an expert and bring.
We love that. Thank you guys.